This week's data does the talking, and markets are listening for the last time this year. Investors are hunkering down, unwilling to take on risky bets as an eventful last week of the year gets underway. Today's US jobs report is the big one, a key test for rate expectations, and more data follows before decisions from the Bank of England and ECB. The full picture of 2025 is coming into focus, but will matter most for markets. Laura Cooper is head of macro credit at Nuveen. So Laura, this isn't a typical jobs report. We're getting November's delayed report plus October payrolls. With all that noise, what will investors focus on?
Well, I think it will be hard to parse through the signal through the noise because the data is going to be distorted. To your point, we're getting October and November all in one go. So it's going to make it difficult for markets to read through what that could mean from the health of the US economy and as well what the Fed expectations could be on the back of this economic data. So while we could see some knee-jerk market moves on any surprises, particularly around that 50,000 headline print expectation for November, I think we're going to see that reaction revert back and markets looking for that next signal in economic data yet to come.
Well, let's look at that knee-jerk reaction. Morgan Stanley is arguing that moderate weakness could actually be bullish. Is this the start of bad news may actually be good news for the US economy?
And that all depends on how the Fed reads through some of this data. If we look at what came through from the Fed meeting last week, we did have Chairman Powell suggest that policy rates are closer to neutral now. This does warrant a wait and see stance, and that's because we are still seeing signs of an overall resilient US economy, and inflation risks still persist heading into next year. When next year we're going to have a strong fiscal impulse come through, we still have support from tech investment and a resilient consumer. So all of those factors may not necessarily warrant an aggressive easing cycle, despite if we see softness in today's data.
Let's go across the Atlantic now, and UK unemployment just climbed to its highest level in almost 5 years, as well wage growth has eased. Is there anything that could stop the Bank of England cutting this Thursday?
The Bank of England rate cut is largely in the price for this week, and I suspect they're going to follow through on those market expectations. But I think markets are still underappreciating the extent of rate cuts that the central bank will need to take on next year. And that's because, to your point, we're seeing the deterioration in the labor market. We're also seeing some increasing signs of growth pressures. And then when we consider the recent fiscal budget, that was an event clearing for overall markets, but that does bring about still an economic drag over the next 2 years. So all of those factors together suggest to our mind the Bank of England should be in a position to cut rates by about 3 more times over the next 12 months.
Some European data as well this morning, but private sector activity disappointed again in December, especially in manufacturing. Are expectations for a Germany-led recovery getting ahead of reality for next year?
I think it's a very difficult call at this juncture. We've been quite constructive on Europe, and that's been underpinned by the defense and infrastructure spending, which we do expect will accelerate through 2026, but we've yet to see signs of that materialize in the data. And I think it's one of the reasons why investors continue to have that caution towards Europe overall for next year. I think if we start to see the lack of that growth impulse come through, any derailment of some of that spending, then yes, that does warrant a cautious stance. But I think at this juncture, we're seeing inflation around this ECB's 2% target. We're seeing credit growth start to pick up. All of those factors does warrant this wait and see approach from the ECB in our mind.
Well, then are markets right to predict the next move will be a hike from the ECB?
That's been our forecast. I mean, it's still a long ways away. If we consider probably late 2026 is when that next move could be. We did have hawkish comments from Governor Isabel Schnabel more recently from the ECB, and I think that markets are grasping onto that narrative. I think the ECB this week is likely going to push back on that, saying it is too premature, potentially alluding to some of the defense and infrastructure spending risks as they're not seeing that materialize. But yes, I would argue that the next move for the ECB is a rate hike, even though that's going to be still several quarters away.
That was Laura Cooper from Nuveen. Don't forget, you can watch more videos on Reuters.com.